Thank you for the question. Yeah, it's a bit of a mystery, and it's recently it's a commonly asked question. Our view for this year has been that we'd see sometime in the second half of the year the economy beginning to recover, and that's indeed what we're seeing. We're seeing slightly higher steel production and cement production numbers. Credit growth is expanding nicely. The PMIs, which, despite all the problems with the Chinese data, people do trust the PMIs, and they're beginning to look slightly better. So there are initial signs. Now, in pretty much every other country, developed or emerging, the stock market leads growth, apart from China. The Chinese stock market has never had a strong correlation with a 6-month forward sort of time period with growth. And there's a variety of reasons for that. I think at this particular time, the first thing is that the political situation, all the political decisions have kind of made people nervous, made investors nervous. And we're still, even though we've got the top 7 and we've got the top 24, those positions are still being filled. And over the next 3 months, hopefully, we'll have more clarity about who's running the country. But secondly, I think when you look at the stock market, it is a bit of a mess still. But the new CSRC chairman, Chua Chin Hon, does seem to be, in the last 6 months, he's done a lot. He's initiated a lot of reforms to try and clean the whole thing up. So there's insider trading investigations, there's disclosure investigations. One of the things that has made Mr. Guo very popular within the CSRC is he's moving managers around departments much more quickly than ever before to try and prevent them becoming too cozy with investors. So there's a lot of kind of change within the regulatory environment. A lot of people, are working to clean up the market. And so maybe it just takes a while before the stock market becomes a more normal stock market. And hopefully, maybe in 2 years' time, those reforms are completed. And at that point, the stock market will start to be more highly correlated with growth.
I'd just like to add a couple of points there. It was quite interesting that you saw the Chinese stock market actually trading at a lower price-earnings ratio than the European market until very recently. I think we are overweight the Chinese stock market within our asset allocation framework. And the rationale for that is, firstly, while there's no real strong relationship with GDP growth, we are starting to see credit growth picking up, and that usually has a good impact on the stock market. Secondly, and probably more importantly, is the earning revisions index has just started to pick up as well. Now, it's actually still negative. So the earnings revisions were falling, they are still falling, but they're falling at a slower pace. And normally that is actually also a very good indicator that a stock market is about to bounce. And indeed, we've already started seeing that coming through in recent times, of course. And I think that's the point we'd be focusing on. If you look at the last time we saw a major bottom in the earnings revisions index in China, the stock market rallied 6 months before earnings revisions actually turned positive. And I think we saw a 60% rally in the intermediate period. Obviously, past performance is no indication of future performance. But those are the sort of things that we are looking for the Chinese stock market. The other side of the argument, of course, is if you look at the stock market by sector in China, financials make up a significant part of that. That is the only sector that is massively undervalued by normal metrics at the moment. And clearly there are a lot of concerns about NPLs. I would argue the NPL issue is actually overblown, but if you're looking longer term out, as we go through the reforms that we're likely to see in China in the financial sector, that may hurt banking sector performance over the longer term. So deregulation there may hit NIMs on a more sustained basis. So that's something to be aware of. But overall, if we're looking on the next 12 months, we are actually overweight the Chinese stock market we're more bullish now than we have been for some time.
I have a good friend who used to work at UBS called Jonathan Anderson. He's a great China economist. And he has a wonderful phrase. He says, China's housing sector is the most important sector in the universe. And the reason why he says that is because not only when China builds houses does it create all demand for steel and cement and glass and copper and all that stuff, and urbanise, which is very important. It also, when people buy a new home, they often are moving out of downtown where they lived in a 2 or 3 story old apartment. They move into a 30-story apartment with a car parking space, and so they go and buy a car. And they've got a new apartment, so they buy a TV and a fridge. and furniture. So what's been happening over the last 8 months is you've seen a very, very strong recovery in the sales of houses, apartments. And so next year, people will start to take delivery of those apartments. And that's when we hope there will be that support for consumption and consumer good demand will kick in. And that's, if you want to understand the Chinese economy, there are two things that you need to understand. Credit still drives this economy, as Steve was saying. When you see credit growth numbers, it suggests that sort of the short-term outlook should be slightly more positive. And when you see the housing sector recover, which it is at the moment, that's also positive for China.
Okay, so two questions. The first question is on China currency. Maybe, Chin Hon, from the U.S. perspective, we heard the rhetoric, and you mentioned that you didn't actually think it was all entirely rhetoric, especially when it comes to Romney's comments on currency manipulation. Maybe just some thoughts on that before we spin around to the rest of the panel for comments on inflation.
Sure. I mean, Romney has been campaigning all year about wanting to label China as a currency manipulator on day one. It's not a position that he came to by accident. I mean, all this stuff are very carefully poll tested, and in places like Ohio, it clearly resonates with a lot of people. Is it enough to win him their vote? That's the question. But there is no doubt that there is a very strong sentiment on the ground, and the U.S. politicians respond to poll results that way. And as to whether he will actually act on it, that's a totally different question. And I think at the end of the day, pretty much everyone is relieved that Romney didn't come into office with a disastrous agenda on day one. But I don't think that issue is off the table entirely. And I do expect the currency issue to come up again in the next year.
On the RMB, just very quickly. So, obviously, it's a huge topic. We talked for a long time. Very, very quickly. Last week, Standard Chartered, we launched the RMB Globalization Index, which is the first index out there which actually tracks the internationalization of the currency. So, to answer your question, track the index every month to see where we're going. I think just, from the central bank's point of view, they would like to slowly liberalise the capital account. I think and I've always been sceptical we'd get there by 2015. I think it's kind of a 10-15 year process. The central bank is very ambitious. Let's see who the new sort of central bank governor is, who's going to be his boss. But it seems to be that this is a sort of a government policy to open up gradually, carefully, the capital account and to push the currency out to the world.
I suppose, remember that a lot of people blame the Asian crisis on excessive liberalisation of the capital account, right? So I think that lesson won't be lost on China as well, even though it's a lot bigger economy.
Shall we spin round to the question on inflation or hyperinflation and broader concerns about that?
Okay, hyperinflation, my goodness. Look, I mean, I've seen articles comparing the US today with Germany just before the hyperinflation days of the 30s. It's not certainly something we expect to happen, but obviously, if we do see growth pick up as we expect over an extended period, the output gap is still very wide, so we've still got a lot of time, I think. Then the central bank will shift its focus from growth to inflation, but to be honest, that's likely to be 2 or 3 years down the road still, even in an optimistic scenario. It's certainly, as an aside, it's certainly something I wouldn't wish on the world. I was a director of the bank in Zimbabwe during the hyperinflation episode there, and trust me, it's an intellectually stimulating exercise, but also absolutely tragic for what it does to its people. I think the overall picture is we will see inflation being more likely than deflation, despite the deleveraging that's going on. At the moment, we expect it to be relatively modest to inflate the debt away. I think the real challenge for this part of the world, and maybe this is for the panel rather than me, but you have got the printing of money in the West, you have got them pushing down their currencies, trying to create domestic inflation, pushing the currencies down also exports that inflation around the rest of the world and within Asia. I know that's a big focus, it has been in China over the past 24 months. I suppose that's a key question to be able to answer when we look at 2013 and into 2014.